we're seeing a 100-year debt cycle wrapping itself up. And, it's a little frustrating because it's not quite fast enough for guys like you and me. I mean, I want it to happen instantly so we can get to the other side, so we can have a sound money system, so my kids and grandkids will live in a much better world. But, if you study history, unfortunately, these transitions can take years and sometimes a decade or two. And I think this one really started in 2008. It kind of started in 2000. It got rolling in 2008. And now we're really rolling. I mean, now, we can all look at the chart of M2 growth or US debt growth or whatever it might be. I mean, we're in it now. We're not going back. So this thing's going to run to its natural conclusion. And, the bright side, the optimistic side of the fact that the money is broken is that it's become so obvious and the math is so relenting that we are going to have a complete breakdown of the system, and we're going to be forced into doing what's right. I mean, people don't, the average people in power don't naturally want to do what's right because they benefit from the way the system is set up. They love it this way. They're getting rich. But the rest of us know that it's wrong, and we know that it's broken. And all we got to do is opt out of their system and save in sound currencies. And eventually their system will collapse, just the way the Soviet Union collapsed. And so when that happens, people will be screaming for sound money again, and we will emerge on a sound money standard, and the world will be a much better place.
Welcome to the Macroscopic podcast presented by GoldRepublic. My name is Alexei Jordanov, and on this format, I invite you to look at the world through different lenses to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the nature of money with alternative assets like gold, silver, and cryptocurrencies. We'll also investigate at how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. Today, I have the pleasure to welcome a passionate sound money advocate and a prominent voice in the gold, silver, and Bitcoin community, Lawrence Lepard. Lawrence has a Harvard MBA and is the founder and managing director of Equity Management Associate. With almost 40 years of experience and a deep understanding of the markets, he has a rare ability to see through the clutter and explain the complex mechanics of money in simple ways. In this conversation, we discuss the looming sovereign debt crisis, the perils of high interest rates and vicious debt leading either to a total financial collapse or hyperinflation. But also the dollar's reserve currency status being under threat, a shift towards commodities and non-dollar transactions, with BRICS seeking alternative trading blocs and move away from the G7 dominance. And next to that, also the role of financial derivatives in market manipulation and the suppression of its gold price. Finally, we also talk about the importance of fixing money for a better world with sound money like Bitcoin, gold, and silver. Hope you get fresh insights and enjoy this conversation. If you do, please like and subscribe, leave your reactions down below in the comment section, and share it to those who need to hear this. All right, so Larry, welcome to the show. Welcome
Thank
to
you. Thanks for having me on board. I've heard great things about the show from my friend Greg Foss.
I'm really glad that he recommended me. I hope I live up to the expectations. Larry, thank you for your time. It's really precious, just as gold and Bitcoin is. I want to actually start with one question I also asked Greg, and it's a very simple question, has nothing to do with finance, and it's what is or was your childhood dream?
Oh my goodness. What was my childhood dream? I think I wanted to be either a pilot or an astronaut. I actually ultimately became a pilot. I was always fascinated by flight. And that's actually on Twitter, recently somebody said, what's your one largest unfulfilled dream that you might be able to fulfill? And I said, it would be to get a ride in a military supersonic jet. And so films like Top Gun and the Maverick film, I just love that stuff. I love fast airplanes. So it's not really related to Bitcoin or gold or anything else, but it's just, to me, the notion of going fast is pretty cool. Racing cars, downhill skiing fast, speed is kind of fun. So,
is it the adrenaline that is...
I think it might be the adrenaline rush. Yeah, for sure. I've tried to stay away from the super risky stuff, the motorcycle racing and all that kind of stuff. But but yeah, the speed. I was a skier and I did downhill ski racing, and I really enjoyed the downhill. Actually, is my favorite event. So going fast is fun.
Actually, on a little side note on that, do you think that the movie Maverick was quite realistic in the way
I don't know about that. Probably not, but it was fun and it was entertaining.
Definitely.
And they did do some good shots. I mean, they obviously took a lot of effort to get those, some of those military shots. I mean, I know people who have had rides in those jets. I mean, it's quite physically demanding. I mean, the G-forces and everything else, it's hard to do and very easy to get sick if you're being pushed into that condition. But, it's amazing stuff. I'm not a big fan of Empires, but they sure do create fun toys like supersonic jets.
Yeah, I hope also for good use. Maybe one day we'll be able to travel on those instead of bombing people. So that might be a bit better.
Yeah, exactly.
Okay, so fast forward, moving in the speed of how much is Mash 2 or what is the
Mach 2? Yeah, right.
Mash 2. Through those questions, one thing that struck with me, I mean, you're giving a lot of interviews out there, and actually, what I like about you is also you're just plainly spoken. You just say what you think. And
yeah, my wife she cautions me not to do that, but yeah.
Well, I see value in that. In the Netherlands where I live, it's kind of Dutch directness is also a practice here. But one thing that struck me is in your Twitter bio, it says "Fix the money, fix the world," and I was candidly wondering myself, why do you believe that fixing money can fix the world?
Yeah, it's complicated. It takes a little time to explain it, but in my opinion, we're in a fourth turning, and that's kind of a cyclical program described by Strauenhaus. And most people listeners have read the book. And the thing that I think is really most broken in our society is the money. And I think our grandkids will say, I can't believe they had a committee of 10 old people sitting around setting the interest rate. They didn't let the free market do it. It'd be akin to when I was a kid, the Politburo used to set the price of grain, and they set it too high. They had a lot of grain, and they set it too low. They didn't have any grain. And to me, the fact that the price of money is controlled by the state apparatus has just led to all kinds of perversions in the marketplace. And it's led to inequality. It's led to wars. It's a bad thing in a lot of ways. And if you actually look at the whole 20th century, of all the warfare and things that happened, I mean, in my opinion, a lot of those wars wouldn't have been doable without fiat money and the ability to create credit and the ability to print money, because governments would have been constrained in terms of their costs and what they could have spent. They'd have to spend what they actually brought in, and nobody would want to pay the taxes necessary to pay for the wars. So, and if in turn, if you look at the prior century, the 19th century and the 1800s, I mean, we had one nasty civil war in the United States. But other than that, around the world in general, as a general rule, the wars were much smaller, much less. We didn't have, World War II, which killed 50 million people. So I actually think sound money is a moral issue. And it goes back to the Bible even, sound weights and measures, honest weights and measures. And so the minute you start to mess around with the money, then what you attract is people into the money business that are criminals. And you attract a political class that prints money to benefit themselves, and you get quintillionaires like Charlie Munger and so forth. And you get people who figure out how to game the system at the expense of everybody else because they're closest to the cheap money, so to speak, the money spigot. And so the politics become corrupted, business becomes corrupted, all the incentives become corrupted, and you misallocate resources, and it causes, in my opinion, unsound money is the base layer foundation of nearly all the problems that we have in the world today. And that if you were looking at one thing that you could fix, to make the world a better place, in my opinion, it would be to return to a sound money standard. And so, and I think there's a lot of evidence of that in studying history. And so, we need to do it. If we fix the money, we will fix the world. I think, a lot of Bitcoiners say, when somebody describes a problem in the world today and they say, Bitcoin fixes this. And it really kind of does, because it's a sound money standard. And a gold standard would help fix it too, although the gold standard has been broken because governments have figured out how to manipulate the price of gold. And I worry that they'll figure out how to manipulate the price of Bitcoin, but that's a different topic. But the point is that you can't build a society. I mean, prices are information, and information is what causes people to do what they're going to do. And information is what causes the proper allocation of resources. And the fact that we've corrupted the information means we've misallocated resources. And if you think about, from your point of view, my point of view, all of the advances, all the amazing technological advances that have occurred in the last 40 years, we all should be living much better lifestyles and working 30 hours a week. I mean, look at what the computer has done. Look at the fact that we're talking around the world here, on a video chat that would have required an airplane and a lot of time for us to have otherwise. I mean, these are amazing innovations. And as a result of these, we should all have a much higher standard of living, but we don't. Everyone's still kind of struggling. Most people are still kind of struggling to pay back their debt and or to beat the inflation monster, which continually debases what they earn and what they try to save. And the reason that's true is because the money's broken. And as my friend Jeff Booth so accurately points out, we've got a deflationary technology environment, and we've got a system, a Keynesian system that by its very design requires inflation. It absolutely requires inflation, or else the system will implode. And so the conflict of those two things, that's what we're seeing coming to a head right here, right now. I mean, we're seeing a 100-year debt cycle wrapping itself up. And it's a little frustrating because it's not quite fast enough for guys like you and me. I mean, I want it to happen instantly so we can get to the other side, so we can have a sound money system, so my kids and grandkids will live in a much better world. But, if you study history, unfortunately, these transitions can take years and sometimes a decade or two. And I think this one really started in 2008. It kind of started in 2000. It got rolling in 2008. And now we're really rolling. I mean, we can all look at the chart of M2 growth or US debt growth or whatever it might be. I mean, we're in it now. We're not going back. So this thing's going to run to its natural conclusion. And, the bright side, the optimistic side of the fact that the money is broken is that it's become so obvious and the math is so relenting that we are going to have a complete breakdown of the system, and we're going to be forced into doing what's right. I mean, people don't, the average people in power don't naturally want to do what's right because they benefit from the way the system is set up. They love it this way. They're getting rich. But the rest of us know that it's wrong, and we know that it's broken. And all we got to do is opt out of their system and save in sound currencies. And eventually their system will collapse, just the way the Soviet Union collapsed. And so when that happens, people will be screaming for sound money again, and we will emerge on a sound money standard, and the world will be a much better place, in my opinion. So that's kind of a long-winded answer, but it really is, to me, in the latter part of my life, I'm trying to do my job, for my investors and myself, but I also would like to have a legacy of standing up for what I believe, something I see very clearly that's wrong, and something that I see very clearly that needs to be set right. And if we do set it right, your generation, my kids' generation, my grandkids' generation, I don't have any yet, but hopefully I will, is going to have a much better future. So that's kind of the big picture on it.
I think you literally shot through all my question.
Oh no, I'm sorry.
No, but that's great because that gives a bit of a teaser, because we're going to unpack some of the things that
go wherever you like.
So that's perfect. Let's maybe start, because you mentioned cycles quite a few times as well, and I'm pretty sure you're familiar with the long-term debt cycle from Ray Dalio. You just mentioned the fourth turning, but there was also other, but that's maybe more price-driven, the long Elliott wave theory, quantitative cycles. Like all those cycles, they have this commonalities, this similarities of 60 to maybe 80, maybe to 100 years cycles. It's more generational, like to just quote maybe the fourth turning. What does it indicate? Because you also had what you coined as the debt doom loop. How does that fit within those cycles?
Yeah, I mean, so what, and I talked about this in my fourth quarter letter. I mean, what happens with debt is that in the early days of an economic system, people start taking on debt and they use it to do productive things. I mean, debt in and of itself is not inherently bad. I mean, if you borrow money and you use that money to invest in something that creates economic value that's over and above the cost of the investment and provides a return in excess of the cost of the debt. That's good debt. That's the debt you want to have. You're borrowing from the future to increase your productivity so that you'll have more, with less. And that's how all these cycles start out. And that's where, the US and a lot of other countries were, earlier in the century a couple times. I mean, there was a slight blip when we had World War II and took on a ton of debt, but we worked our way out of that. And, so maybe go back to the 1950s or so when, US debt to GDP was under 30%. That was most of the debt that was taken on cautiously and for good reason. What happened is that the government and others in power began to realize, and it started with Greenspan in the 80s, it started a little bit with Reagan. They all kind of began to realize that, you could use debt to create economic growth. And, and in the beginning, it was pretty good. I mean, you borrow $1 and you get $2 or $3 worth of growth. Well, now, you borrow $1 and you don't get any growth, or you borrow $1 and you get 30 cents worth of growth. I mean, it's the marginal utility of the debt goes down as you get more and more of it. And what happens is, and there's a chart I use on Twitter, which shows kind of the growth of the U.S. debt burden as against the growth of the GDP. I mean, so debt is used to in theory, debt is used to increase productivity, increase output. And if it's done correctly, then these lines track together. You borrow some money, you get more output. You borrow some money. But unfortunately, what happened, and particularly because of the manipulating of interest rates and going off the gold standard in 71, is that we got into a situation where debt became too easy to take on, and we just kept taking on debt. And we're now at the point where we've got so much debt. I mean, the U.S. federal debt is 130% of GDP, and the GDP is what pays the interest on the debt. And we're not getting the kind of GDP growth we need, and yet the debt continues to grow. And so, something's got to give. Either the debt has to fail and become worthless, or we've got to have massive inflation to get GDP to grow so that it can support this level of debt. But there's no other course. It's mathematical, as Greg points out. So, and this has happened before. I mean, there was a lot of debt the last time. I mean, and so what we've got is kind of we've got a debt crisis. I mean, it started earlier, it started 20 or 30 years ago. It kind of manifested itself in the dot-com bubble. It got worse with the housing bubble. And now it's at the sovereign level when, the big crime was when they kept interest rates at zero from 2009 to 2015. I mean, that was just insane. I mean, 6 years.
Why do you think this so zero low boundary policy?
They wanted to inflate another bubble. They wanted to get the economy going, and they knew who it would benefit. And the people who knew that it was going to stay there did fabulously well. Look at all the wealth that the people who understood how the system worked and were at the top of the system. Look at the wealth that these people attained. I mean, it was crazy. And politicians loved it because they didn't want to have any downturns. They didn't want to have any recessions. They didn't want to have people getting laid off. And because they were doing it against a backdrop of deflation, because we had a lot of cheap labor coming in from China, we had shale oil in the United States, we had, a lot of other things that hid the underlying monetary inflation, it all kind of worked until it didn't, and the until it didn't part was when, COVID, and they grew money supply 40% and sent out stimulus checks. And then more recently, more importantly, in my opinion, when Russia invaded the Ukraine and suddenly commodity supply lines got chopped and we grabbed a bunch of, Russia's reserves, and everybody kind of suddenly realized, we're no longer in a deflationary environment. This is an inflationary environment going forward. And, so it becomes a doom loop, as you alluded to earlier, because in the U.S. case, 3-4 years ago, the U.S. federal budget was supporting about $300 billion a year of interest charges on the debt. And that was because, we had 20 in the high 20s and high 20 trillion dollar level of debt, but the average interest rates were 1 or 2%. Well, the problem is interest rates are going up sharply. And the debt continues to grow too, because we haven't gotten the deficits down to zero. And so as a result, as we all know, you can see the chart, more recently of what's going on with the U.S. federal interest costs.
It's funny you say that. I just literally had it.
Perfect. Oh, thank you. Yeah. I wish I linked it up. That's the perfect chart, right? I mean, it's going kind of straight up. I mean, we're kind of running at
Parabolic.
on our way to $1 trillion of annual debt, costs on this debt, and yet we've still got very serious inflation. And one would argue that the real rates are still negative, even with a 4.75, Fed funds rate. I mean, the interest rate. I mean, the inflation prints have been higher than that, not by a lot, and they're coming down, but. But the point is that, in the Volcker case, he had to take, back in the 70s, last time we had an inflation problem, he had to take interest rates to 20%. Well, that's not even in the possibility of outcomes today, because to take rates to 20% would imply that, $30 trillion, $31 trillion worth of debt would have an interest cost of $6 trillion a year, which, the total tax collected in the United States is 4. So, I mean, and that's before Social Security, Medicare, military, everything else that we spend money on. So the point is that we are at the end of this cycle and something has to give. And, how exactly it's going to play out and how exactly it's going to give, that's kind of tricky. And that's, that's quite hard for all of us in the sound money camp to live with, because our stuff is volatile. I mean, and at the end, as my quarterly letter pointed out, at the end of 2021, I thought we were having a crack up boom. I mean, everything was going straight up. The stock market was going straight. Everything was going straight up. And Bitcoin was 65,000. Stock market was record highs. I mean, et cetera, et cetera. And then, we saw Powell come in and try and be Volcker, and he slammed on the monetary brakes and started jacking rates faster than ever, or almost faster than ever. I think Volcker did about the same rate. And what we're seeing now is just an incredible slowdown. And they're trying to get that runaway inflation under control. And of course, that was very damaging to the price of gold and to the Bitcoin price. And but my suspicion is that those things cannot last, because if they continue with this higher rate of interest, something's going to break. And at the end of the day, they've got a bunch of things they're trying to do. They're trying to get full employment. They've kind of got that roughly. And they're trying to control inflation. They don't have that at all. And what they're saying is they want to get inflation back down to 2%. I don't think they can. But my suspicion is, and Powell did this in his most recent conference, or his most recent press release or press conference, where he said, I think what they're going to do is they're going to get some good inflation prints here in the next couple of months. And they're going to use those to say, look, we're winning. Inflation's going down. We're on our way back to 2%. And so we're good. We're stop raising rates at 5. And even 5 will ultimately cause problems. But my sense is that, Bitcoin and gold smell that and know that that's coming. And that's why from, say, October, November of last year to present, Bitcoin's up 40% and gold's up 20%. I mean, they smell the additional monetary easing. And the reason that easing has to occur is that if they don't ease, they are going to seal their own fate, because their interest costs are going to overwhelm their revenue. And they know that. I mean, I think, they can do the math just like we can. And so my suspicion is what's going to happen is we're going to have a decade that looks a lot like the 70s, maybe on steroids, where we have pretty high inflation. And maybe the economy hangs together and grows. I don't know. I don't think it grows a lot, but maybe it doesn't fall apart. But I think that, I think inflation, the big mistake I think a lot of investors right now are making in the mainstream is that they're thinking that, we'll whip inflation, we'll go back to the conditions that existed. And it's very common for investors to say, well, look, it's been this way for 20, 30, 40 years, deflationary, and the stock market since 2009. Anybody who's been on the stock market since 2009 has been heavily trained to buy the dip. And I have a lot of friends right now who say, well, my portfolio is down 20%, but you got to be long-term oriented and it's all going to be good. And I know it'll go back up again. And I think they're going to be sadly disappointed. We're still at a pretty high valuation level. The bubble was quite extreme. And we've seen in history that when bubbles burst, they don't just kind of go down 20% and stop. They tend to go down close to where they started. And so that would imply to me that we've got some nastiness coming in the stock market. And once that starts to occur, and then you get more layoffs and you get a bad economy, you've got some somewhat lower inflation prints. At that point in time, I think the Fed is going to get very dovish again. And we're going to be right back at, gold 3,000 and Bitcoin 100,000. So
okay.
That's kind of how I see it playing out. But the timing on that, it could be in a month, it could be in a year. I mean, I'm not really sure on the timing. That's pretty fuzzy. because it's been surprising to me that they've been able. It goes to show you how much momentum the economy had and how much money they printed. It's been surprising to me that we haven't had more problems already. I mean, we've seen some, right? I mean, England had some problems. The
Japan
Japanese,
as well.
Japan had problems. They had to bump the yield curve control, the rate on their 10-year up. I mean, there've been cracks. I mean, I call them, kind of rivets popping, but nothing really serious has happened yet. I mean, it's kind of, things are kind of quiet out there. And okay, that's fine. I know the side of this thing that I want to be on. And, I think in investing, you can't nail it day to day, month to month, but you can get multi-year trends correct. And I'm pretty sure that we are on the right side of the multi-year trend by being in sound money, because the mathematics of the debt situation, that there's just no way, there's no other way to fix it. They've got to print. I mean, they could, let's talk about the alternative. Theoretically, they could not print. I mean, he could try to be Volcker, but if that's the case, we're going to look at something that looks like the 1920s. I mean, we're going to have a depression, or the 30s. I mean, we're going to have an outright depression, because you're going to see everyone who's overly indebted is going to be going bankrupt. And, and as we all know, it's a fractional reserve system, right? So, when somebody goes bankrupt, well, then they lay off all their employees. Well, all those employees now no longer have income, so they all own houses. Whoever wrote the mortgages on those houses, they're having trouble. And it cycles all the way through. And they know that. I mean, the people who run this, the Fed knows that. The central bankers know that. They won't let that get started. But for now, it's hanging together and they're being tough. But the market it's funny. The market is even saying they can't be that tough. I mean, if you go to the futures market, and there are CME futures and other things that show you, a large percentage of the market thinks that by the end of 2023, the Fed funds rate is below where it is right now. Wow. So the market is already counting on Fed easing later this year. It's saying that things are going to get tougher, and inflation's going to, they're going to declare victory on inflation, whether rightly or wrongly, and then they're going to ease. They're going to ease, sometime later this year. And I think that's right.
Yeah. On that point, actually, I've just seen a tweet from Lynn Alden. She said, like, the problem is not coming back to 2%. It's having growth after that without having another inflation spike. And it's kind of definitely resumes also your point, is that you can maybe go back to it, and you will still have to fight this genie out of the bottle that you will not be able to put back, because you cannot afford, your tools are basically being blunt. Central banks have tools that are blunt. Is that correct?
I completely agree. And I saw that tweet by Lynn as well, and I retweeted it. And she's brilliant. I mean, their tools are broken because of the corner that they're backed into here, mathematically. And I think that it's a small percentage of the world that fully understands that. I should say a small percentage of the investing world. I think gold people understand it. I think Bitcoin people understand it. I think all sound money people understand it. But, we're maybe 5% of the population at best, maybe 10. I don't know. I mean, I don't think the entire world understands. I think the average American thinks, okay, well, this will get under control. Inflation will come back down. We'll go back to where we were, and my stock portfolio will be great, and it's all going to work out okay. And it's not. It can't. I mean, that's not a political judgment. That's a mathematical fact. This, a good example is this year's budget deficit. Luke Roman just put it in his newsletter. I mean, they this last quarter, the Treasury had to fund $900 billion worth of debt. So if that's a quarter, and I think it's going up by quarter, but even if that's just the quarterly run rate, that implies that this year the deficit could be $3.6 trillion. I mean, last year the deficit was only 1.4, but that was because they had a one-time spike. The 2021 stock market created $600 billion of tax revenue on capital gains. But last year the stock market was down on the year. So that's gone away. And the spending continues to ramp up, and tax revenues, the economy is slow, so tax revenues are going down. And so, I think the U.S. government is looking easily at a $2 trillion deficit this year, easily, probably 3, maybe above 3. I mean, the last quarter was running at 3.6. So, that's a big number, right? And that's more debt that has to, that interest has to be paid on. I mean, the 31 trillion of debt will become 34, and then 34 will become 38. And so on and so on, right? And unless the GDP grows substantially, and it is growing. I mean, but it's not actually growing in real terms. I mean, GDP. So if you've got inflation of 9% and GDP is up 4%, you really shrunk 5% in real terms,
Mm-hmm.
right? I mean, you didn't sell more stuff. You didn't get 4% growth. You just got a 4% bigger number because the price of everything you sold was higher. So, there are a lot of moving pieces, but the point is that they are trapped, and and so I think the right conclusion from that as an investor is start to study and understand what it means to be an investor in an inflationary environment.
Mm-hmm.
And I kind of remember this. I was a teenager, so I wasn't, an active investor, although I kind of looked over my grandfather's shoulder. But I remember the 70s very, very clearly. And inflation was just relentless. And it came in waves. It came in like 3 big waves. It just couldn't get it under control. And, the economy wasn't growing. It was, that's how the term stagflation got invented. No growth, but the price of everything kept going up. And it was because of all the monetary excesses. It wasn't quite, we weren't nearly as indebted then, obviously, as we are now. We were at 35% debt to GDP. Now we're at 130, which is what allowed Volcker to do what he did.
Mm-hmm.
He just said, I'm going to stamp this thing out. I'm going to create an enormous positive real rate. And he did. But now we're kind of at the opposite end of that spectrum. I mean, I think, in my opinion, we hit peak deflation in March of 2020. I mean, there was a time, I think the 10-year traded below 1. I think it might have traded down into the 60, 70 basis point area. I'd have to go look. But, that's just amazing. And as you'll recall, there was all kinds of negative debt in Europe. I mean, people were actually paying to lend money to people. It just made no sense.
Crazy.
Crazy, yeah. Right? And so now in my opinion, that corner has been turned. We've entered an inflationary world. Inflation will wax and wane, as Lynn points out. It could go as high. Last time we went as high as 9. Maybe it comes back down into 2 or 3. But part of the other thing that's masking inflation right now, oil is kind of under control. Oil was 120 at the peak. Oil's in the 70s right now. But that's somewhat distorted because the U.S. just drained its strategic petroleum reserve. And I mean, we took it down a lot. And as a result of that, we created a lot of excess oil that allowed prices to come in and help Biden win, not get wiped out in the midterm elections. And so, that we're now refilling the strategic petroleum reserve, and China was shut for their COVID problems. They're now reopening, so they'll be using more oil. So my sense is, I watch the price of oil very carefully, and I think that will be a leading indicator that we're going to get back into another one of these inflationary up cycles. Mm-hmm. And I expect to see that later this year.
So there's also, you just mentioned about just the fact that the servicing of debt is unbearable. And I think just recently also Jerome Powell mentioned that it is, and that's what's being debated right now in the US, as understood, is basically uncapping totally, so removing totally any debt ceiling for the US government. So increasing potentially fiscal deficit, or fiscal spending, at least expenditure, by an infinitum, by infinity. Having
the whole US government debt limit, congressional spending, I mean, it's all like kabuki theater, it's kind of a farce. I mean, they have a limit and then we exceed it, and we always approve the exceeding. I mean, it's almost like, why have a limit? But, and as Kevin McCarthy, the Speaker of the House now, he got that seat by promising some of the hardcore people in his party that he was going to cut spending. And I don't know, my sense is this time they actually will take it maybe right to the brink of potential default. There are people in Congress who want to actually cut back and limit spending. I don't think that it's a majority of Congress, but I think it's a piece of Congress. And, to me, all of that's just a big clown show. I mean, it's all for the consumption of people outside. I mean, we know that they're ultimately going to approve an increase in the debt limit and not really cut spending very much, if at all. Mm-hmm. Because they just can't. Now, it's I suppose it's possible that a different set of people in office could cut spending. I mean, but if you consider where most of the spending is, and this is the other thing that makes it very structural, the biggest piece of the spending is in, the Social Security and the Medicare and Medicaid for the baby boom generation, or my generation, basically. And we're all retiring right now. I'm right in the middle of the baby boom. I was born in 57. And, we are all, or I'm at the middle to tail end. We're all retiring, and, we're healthy. Many of us are healthy. We're going to live a long time. And so, those benefits need to be paid. And, and any politician that wants to try and touch that third rail of cutting that stuff back, forget about it. They're not going to be in office for very long. So
Yeah.
It's, the other big expense is the military budget, which is, just under $1 trillion, and, sending a lot of money to Ukraine and supporting them in the war against Russia. That's not exactly helping reduce the military budget. So
No, and also we haven't even talked about actually commodities, the price of commodities, which will in the long term, you just pointed out, so I actually would like to do a rail into that subject, is the Cold War era is warming up again. We have different blocks. And I think you've also been really busy back in your previous fund, I think
Capital.
Capital, sorry. Also really looking at the world as a whole holistically and what's happening there. And I would like to take get your opinion on that. How you see the emergence of the West. So maybe I could resume it to the G7 just to make it simple, versus the BRICS plus, and also maybe even more countries who are maybe interested to join that bloc, and how that block is kind of done with the rules of the game, because I feel that they basically do not benefit them. And they want to rewrite that monetary game. And by introducing the reenactment of something like a gold standard or a basket of currencies that would profit them and thereby de-dollarize the world. So that they can benefit more of it. So what do you think those forces entail for then the global economy? And especially now we talked about deflationary pressures and inflationary pressures. How does that fit in the game?
So that's a great segue into a very important area that's going on, which, look, a lot of the wealth and the power that the United States has had and enjoyed has been the result of being, the reserve currency, which, got established when we established the petrodollar, when Kissinger went to Saudi Arabia and said, we'll give you protection, price all oil in dollars. And, the other countries in the world have had to live under this system for a long, long time. And, if you didn't like it, tough starts, we would sanction you, we'd throw you out of SWIFT, et cetera, et cetera. And the most recent, in my opinion, kind of outrageous move, and you can say whatever you want about Russia, good or bad. When we decided that, okay, you invade the Ukraine, we're going to effectively steal $600 billion worth of your reserves that exist in our banking system. How do you think Russia would react to that? Kind of like, oh, okay, that's the way you want to play? Fine. And by the way, every other country in the world saw that too, right? I mean, China holds $1 trillion worth of treasuries. They saw it. India holds a lot of treasuries. They saw it. Japan saw it, even though they're part of the G7. Everybody saw it. It's kind of like, my God, the United States is basically saying, you're either with us or against us. And if you're against us, we're going to steal your money. And so as a result, what's emerging, as you point out, is this block of BRICS countries and other countries that are outside of, the financialized world as we know it. We know the financialized world is kind of the G7, most particularly the United States, Europe, and Japan. And all these other countries, they're tired of it. They're tired of two things. They're tired of us, using the dollar as a club to get them to do what we want them to do. But they're also tired of accepting the dollar as payment, knowing that the dollar is going to debase. I mean, Putin said, why take payments in dollars? We know they're going down in value 8% a year vis-a-vis gold. And so, this has all led to what Zoltan Posner from Credit Suisse has written so much about, and it's brilliant. His work is worth looking up and finding and talking about. Where he said, it's changed from John Connolly's, in the 70s, he said, it's our currency, but it's your problem, when talking about Triffin's dilemma. And now the BRICS and the BRICS bloc, as we call it, they're all kind of turned around. They're saying to the West, hey, these are our commodities. They're your problem. In other words, we got the oil, we got the natural gas, we've got the things you need to run your society, And guess what? We're not going to take dollars for them. We'll trade amongst ourselves in our own currencies. So you see, China putting in a heavy investment in, having the GCC, the Gulf Council countries, be willing to accept the yuan for oil and squeeze the dollar out. And then you see India trading directly with Russia in rupees, using rupees to pay for oil. And, you're seeing kind of all these workarounds to exclude the United States and the United States dollar. And when the dollar was the reserve currency, that gave us the exorbitant privilege of being able to print dollars to pay for energy. But, these moves will diminish the dollar in relative terms against these other currencies and against hard assets, more importantly. And I think what all these countries, including countries like Nigeria, recently set it up. I think it was
Ghana, the oil program.
Ghana just set up, gold for oil. I mean, all these countries are getting smart, and they're starting to realize, what? I've got stuff of value. I don't want to sell it for dollars, or if I do sell it for dollars, I'm going to quickly swap them out and get into things that can't be debased, because the U.S. is debasing this dollar very, very rapidly. And so this kind of reminds me, and this Dalio talked about this in his book, which I'm just finishing right now. This kind of reminds me of the changing of the guard. There was a time when the British pound was the reserve currency, at the turn of the century in 1900. And over the course of the first, 30 years of the century, the pound lost its position as the reserve currency, and the dollar took on that position. It got totally cemented at Bretton Woods in 1944. And I don't think the yuan is ready to be the reserve currency, because, they've got capital controls. They're not transparent. There are a lot of problems with the yuan. So I'm not sure the dollar is going to completely go away as a reserve currency. But I think what is going to happen is that more and more people are realizing the fundamental problems with the dollar, and they're going to be saving and storing value in things that can't be debased. And that would include commodities. That would include gold, obviously. It would include silver. It would include commodities. It would include oil. And to some degree, it'll include other currencies as well. And perhaps at some point, one of these other countries will decide, well, we're going to back our currency with gold, or we're going to back our currency with Bitcoin. And then it'll be, one of the sounder currencies in the world. The problem of debasement of fiat by governments is, this is thousands of years old. This, it's not like, the guys doing it right now invented this. The Chinese did it, the Romans did it, everybody did it. Governments by their very nature need money to operate. And so they have the ability to print money. They will abuse that ability. Mm-hmm. And that's why these two outside of the system forms of money, gold and Bitcoin, are so attractive to those of us who want to avoid debasement. I would say oil is a very close kind of third, because it's kind of the master resource that the whole world needs to, in order to run on. And the problem with oil being money is that oil also gets burnt up. And so you're kind of using money to price. It's better if the money is neutral. Mm-hmm. The notion of having money that's money that gets used and that gets spent or burned is that's a little bit problematic. But the point is, the entire world, I think what America did, America really shot itself in the foot when it grabbed those Russian reserves, because what it basically did is it said, hey, world, figure out how to create systems where we don't need the dollar anymore. And by the way, only a country that has a currency that's sure to debase would take a step like this. And therefore, we need to start figuring out how to save and put our excess to the degree that we're going to create reserves, i.e. we're going to sell more than we spend. We've got to figure out how to put those reserves into something that will hold or increase in value. And that definitely is not the dollar. So that's a long-winded answer. You're also seeing more and more countries join this group. You're seeing some of the African countries. The BRICS used to be just Brazil, Russia, India, and China, but we've got all the Gulf countries are now joining, and Turkey is looking at it as well. Indonesia, exactly. So it's coming, and I think at the end of the day, the dollar will be an important currency. It won't be the only currency, and it will be severely debased in gold, silver, and Bitcoin terms. And people who are saving money, we're right on the cusp of the tipping point where as I've often said, hyperinflation occurs, or the tipping point for our investments will occur when a quorum or a majority of the people realize that they can never stop printing money and debasement is assured. I mean, you know that. I know that. Lots of Bitcoiners know it. Gold people have known it for years. I mean, as I was saying to you earlier before we started, from a gold guy's perspective, I love the Bitcoiners because it's like, we've been fighting this battle for years and years and years, before Bitcoin was even invented. And, now I've got a bunch of 30-year-olds quoting Austrian economics to me. I love it, right? And so, there's a widespread, the knowledge is spreading. And when it gets to the point where it's common knowledge, everybody knows that you would never save in dollar terms, that you've got to put your savings into gold, silver, Bitcoin, even houses or, farmland. I mean, anything real, tangible, something that cannot be printed. That we have a government system that's so broken and out of control that printing is guaranteed. Once that becomes common knowledge, it's all over. Then, it's game over. I mean, it's Hemingway's, slowly and then all at once, and so, and I think that'll become common knowledge in the next 5 years, probably sooner, but.
So just to resume it, just as we had, for example, after the Great Depression, we entered then after like the gold standard into a more deflationary period up to until maybe like the 70s.
Yeah, there was back and forth. Just to recap that period very quickly, we came out of World War II with a lot of debt. The U.S. had a lot of debt, but also was the leading country in the world, the leading currency. It was backed by gold at $35 an ounce. And so there was a stable monetary system, in my opinion, from 1944 into the 50s and actually into the 60s. The first crack in the system was when the U.S. started to spend more than it could and started, to print money to do that. And that was kind of guns and butter, the Vietnam War, et cetera, the 60s. And what happened, of course, is the French figured it out first and said, all right, you want to do that? That's great. We're sending boats over. You just give us the gold instead of these dollars for the wine you want to purchase. And so, at one point, the U.S. had 20,000 tons of gold. We're down to 8,300 tons. So this was a big gold drain, during the 60s. And at some point, Nixon looked at it, and Nixon and his advisors looked at it and said, holy shit, if we lose all the gold, we're really screwed. And so they went off the gold standard in 71. We defaulted, really. No one says that, but the U.S. defaulted in 1971. And of course, that pretty quickly played itself out, and gold went from $35 to $800 as a result of that default. And, and that's what brought the inflation, right? That all the money that had been printed came home to roost, and we had enormous inflation. And, there were other things too. There was the oil embargo and the Middle East gaining power over the pricing of oil and gaining power over Aramco and saying, hey, it's our oil, we're going to charge what we want for it. But the point is that we had a very inflationary decade in the 70s as a result of an unhinged monetary policy. We had money tied to nothing. It was truly pure fiat. There was no gold standard. And interestingly, I mean, I said this math in the past, people should be aware of it. I mean, there was a time in the 60s where you could take all the gold the U.S. held, you take the money supply, you divide the two, and you kind of came up to $35 an ounce, which is the reference price from Bretton Woods. I mean, it kind of worked, right? Well, so that's fun, right? So let's do that same math today, okay? Take all, right? I mean, let's use M1, M2. It's 80. Gold should be at $80,000 an ounce.
Wow. Okay?
That's how much money we printed, right? Compared to the amount of gold. And that's assuming the U.S. has the 8,300, tons that we say we have, which, there's some debate about that, but that's a different subject. But anyway, so there's been a lot of monetary debasement, right? But Volcker got it all under control, pushed interest rates up very high, and actually for a period of time in the early 80s, even though we were running deficits, they weren't that large, and we had a lot of room to grow the debt, and so we did. But each cycle we took on more debt and more debt and more debt. And now we're kind of at the point, where, I mean, anyone knows that if you take something and you compound it at say 7 or 8 or pick a number and you just keep multiplying, eventually it starts to go parabolic, and that's kind of where we're at right now. Yeah. And so, something's got to give. And that's back to the unrelenting math that I talked about that gives me such confidence that we're in the right place.
Mm-hmm. But like, let's talk about math and valuation of the
Sure.
price of gold specifically. I mean, if you're in the gold industry, you pretty much assume that the gold price has been manipulated by the
Oh yeah,
COMEX and all kinds of, I mean,
absolutely.
JP Morgan's commodities traders were charged,
Yep.
I think, last summer into spoofing. That's nothing new. The manipulation also happens across the board.
Uh-huh.
But it is particularly maybe painful for gold, right? Because
Oh
gold
yeah.
is supposed to be that.
Well, and
Big,
in spite of all that manipulation, by the way, if you look at Ronnie Stofferle's charts, I mean, it's still grown at 8% a year, and
yeah,
that's I mean, which is look, that's not horrible. I mean, there was a time when you could look at it and say it's outperformed a lot of stock markets, but yeah, I mean, it started with Barsky and Summers. They wrote a paper on Gibson's paradox. I mean, Robert Rubin was the Treasury Secretary under Clinton. James Carville under Clinton said, hey, I want to come back to the bond market because I can shove everybody around. The bond market's got more power than anything else in the world. And Robert Rubin said, don't worry, we got it under control. We're gonna suppress the price of gold because gold is the fire alarm that shows that we've got monetary debasement going on, and you guys can have at it. Go ahead and print. And that's how they did it. And so, the gold derivative market is what they used, and they did it out of the Cayman Islands. They did it out of all kinds of proxy accounts. They did it through the banks. They had all the spoofing, et cetera. And that all was, the people who run the fiat system recognize that the price of gold is an existential threat to their system. They know that. They're not stupid. And yet, if you have an unlimited balance sheet and you can print money and you can do things off balance sheet, which, by the way, I think they do. I mean, if you read deep into a lot of the federal statutes, what you realize is that some of these things are regarded as a matter of national security. I mean, I think the Pentagon, views the strong dollar as a matter of national security. And so, it's not, I'm quite sure, and Catherine Austin-Fitts and others have talked about it, I'm quite sure that, they can set up accounts, short gold, provide paper gold they don't have to push the price of gold down. And if that account ends up losing money, that's no problem. They just print it off the books and pay the money out to the losers. They accomplished their goal of not letting the gold get through a certain price level that was important to them at that point in time. So, and the BIS does it as well, in my opinion.
Yeah, but wasn't there an act? I think I've listened to this in one of the podcasts recently. Is that there's an act and a Fed Act that actually can just seize gold like it did in the 30s.
Yep.
It still is provisionally also the case today. It is by de facto, since it actually decoupled from the dollar from gold. It can do this actually with pretty much any market. How can we live under such a kind of knowledge? I mean, how is that even like?
Well, it's pretty bad. And and by the way, I mean, let's take that into Bitcoin for a minute, okay? Because I mean, look, in my opinion, Warren Buffett is, I don't like him at all, but he's right that derivatives are weapons of, financial weapons of mass destruction. And, any market price is set at the margin by the marginal buyer and the marginal seller. And if you have a bigger balance sheet than anyone else, and the United States balance sheet's probably the largest in the world, and the BIS, you add it to the BIS and all the other central banks, they're definitely the largest in the world. If you have the biggest balance sheet, you can use your power to manipulate any market through derivatives. You just, you don't have to have the gold. You just go in there and sell gold you don't have, and the buyer takes it. And so, there might be a lot of demand for it. Doesn't matter. You've sold them paper, and they've accepted the paper. And so, so this is what's happened in the gold market, and it's built up cumulatively over the years, and it's what's helped to suppress the gold price. They haven't had as much time to do it with respect to Bitcoin. And there are Bitcoin derivatives, not nearly as many as there are gold derivatives, But having said that, there is still the risk that ultimately they could figure out a way to sell enough paper Bitcoin. And this is what Charlie Munger, alludes to when he says, hey, don't ever believe that they tell you there are only 21 million of them. And what he, of course, is alluding to is the fact that, we can create more than 21 million. We just create paper Bitcoin. And if people are willing to accept it, then at the margin, that drives the price. And so, one of the things that I think we're going to have a huge financial collapse here. But if I get a say in how we rewrite the new system, I think one of the most important clauses of the new system is going to be to literally outlaw financial derivatives, to ban them. to make financial derivatives just illegal. I mean, completely illegal. I mean, maybe you could have futures on corn. I mean, other than for commercial purposes. So if a farmer has corn and, a cereal manufacturer wants to buy corn, fine, they can do a futures contract on that corn. But, beyond, unless you have a commercial interest in anything, you cannot be buying or selling it in the marketplace. That represents a price distortion, which by its very nature is designed to rob people, particularly when you're the biggest balance sheet in the game. Mm-hmm. And so, if you want to get back to, the efficiency that naturally comes from honest prices and honest markets, you have to make sure you eliminate every game that allows somebody to benefit as a result of the structure. And, that's the derivatives are one of the biggest games, that do that. And so banning them, in my opinion, look, when Wall Street blew up in 29, there were a lot of shenanigans going on, and the SEC came in with the 33 Act and the 34 Act, and they fixed a lot of things. I mean, they created a lot of laws that made things better. I mean, they did with respect to stocks. And so we're going to have a similar blow up here, in my opinion. This whole shit show is going to collapse. And I'm hoping that when people get called up and brought in and say, okay, how do we fix this? What should the new laws be? One of them has got to be financial derivatives are outlawed. There are no financial derivatives over and above derivatives necessary for a commercial interest. Period. Done. You get caught doing that, go to jail. It's just.
But isn't it one of the biggest markets out there?
Oh, it's huge. I mean, look, all the paper shufflers and all the Ken Griffiths of the world, all these people who've made themselves fabulously rich by gaming the system, they would hate that. Mm-hmm. The governments, they would hate that because it allows them to. That's what allows them to spend more money. Yeah, everything. But in turn, what the average man doesn't realize is just how badly they've been screwed by this system. I mean, explain to me how, we have had all these enormous technological and productivity improvements over the last 50 years. And yet, and don't get me wrong. I mean, people today do live better than they did in some respects 50 years ago. I mean, they just have technologies they didn't have. But, even in the 70s, I mean, one income could support a family very well. And now people struggle, with multiple incomes. I mean, it's just, there's the system is broken. We have misallocated capital, and that has cost all of us very badly, in my view.
So to wrap it up, because we're running out of time.
You can go a little over if you like.
Yeah.
Whatever.
Okay. Yeah. One of the theories that that caught my attention was the not unofficial, maybe rebalancing of gold reserves across central banks around the world. The U.S. still has by far the biggest gold reserves, but it did. But it did kind of especially when China joined the World Trade Organization. I think one of the deals was you sell us a bit of gold to rebalance a bit those power forces. And also the notion of GRAs, so the gold revelation accounts. That's what also is used to kind of measure those kind of metrics. Jan Newhouse, which actually we know, and I guess you also know
he's great. I like
he's
him a lot.
Fantastic. He came quite a few times to the office here. He has this theory that at least in Europe, central banks all across Europe are implicitly trying to kind of even out their reserves as a proportion to GDP. And if you look at it then worldwide as well, which actually makes sense. If the euro fails, there's a kind of a fail safe that you could just go back to gold, right?
Yeah, right.
And the same goes then globally, I guess, right? With this, as you said, right? It cannot, math just doesn't compute here. Error 404, page not found, you cannot go on.
Right, yeah, no, it doesn't work.
It doesn't work. So one of our other friends, Willem Middelkoop, he is a proponent of the big reset.
I know well. He's great.
Yeah. Yeah, and his thesis is that this is the way it's going to go down. At some point, we'll have to reevaluate everything, all the debt, write off the debt, and compensate it with the other part of the balance sheet, which is mainly gold, the hard asset, something you cannot cheat on. What is your take on that?
Well, I think that's right, and I think obviously the price of gold is measured in today's fiat currency. It won't be in the same zip code. I mean, it'll have to be a lot higher, and people who have gold will suddenly have a lot of wealth as a result of having it. The stated reserves. And this is part of the problem with the gold standard. What the Bitcoiners always talk about is, who's lying? I mean, where's the proof of work? Can we see the ledger? Do you know what I mean? Ron Paul told me once, sitting in his office that, he's pretty sure the U.S. doesn't have the 8,300 tons we say we have, right? And so, and I'm pretty sure if you look at the Swiss export numbers, and Ronan Manley's done great work on this. I'm sure you've spoken to him as well. If you look at the Swiss export numbers, China has a lot more gold than they're reporting. There's been a lot of gold that's gone from Switzerland to Hong Kong to China, or directly
unreported.
to China.
You mean unreported? That has not been able to trace to any ledger.
Well, yeah. I mean, in other words, I think there's central, and so some of it's owned by the citizens. Okay, just don't get me wrong. And as you recall, I don't know if you recall this, but in the early 2000 period, there was a time when China was actually advising its citizens to buy silver and gold, to save in silver and gold. I mean, kind of, they knew it was going to be an important thing. But yes, I mean, I think China's reported gold holdings, official reported gold holdings, are vastly understated. And that would fit with the way
why would that be then?
Because they're playing the long game, and so they don't want to threaten us. They don't want to. I mean, my sense is they buy it, and they buy it on the QT, and it's Sun Tzu, right? I mean, you feign weakness, you feign that you don't have it, but one day when the dollar comes crashing down and all these fiats become worthless, which they will, China steps up and says, "Oh yeah, by the way, we've reported that we have 1,800 tons of gold, but in fact, we actually have 18,000 tons of gold, because we've been accumulating it quietly under the table."
It's
and
bamboo.
Yeah,
you heard about the analogy of bamboo? Bamboo grows 10 years below the ground,
and then suddenly it shoots up. Right, exactly. It's like the price of Bitcoin, right? So, yeah. So I mean, and as I say, Ronan Manley from Bullion Star over in the Far East has done a lot of work on this. You should reach out to him and talk to him about it. But again, it is part of the problem with the whole gold standard. Who knows who has what? Do you know what I mean? But one thing is for sure, that if the fiats truly do fail, the market price of gold is going to be much, much higher than today's market price, and that it's possible that in this fiat failure, they'll come back and they'll try another fiat, or they'll try a CBDC, or they'll try some other solution. And I suspect that the average person is going to go, "No, we don't trust you. I'm only going to get paid in gold, period." I mean, and this goes back to the BRICS discussion, right? I mean, everyone knows what a barrel of oil is. Everybody knows what, wheat is. Everybody knows what gold is. Everybody knows what silver is. I mean, it's, they're pretty straightforward. I mean, and so, the price of those things will be set in the marketplace. And I think it'll be set in their favor versus the favor of a currency like the dollar, where everyone goes, this damn thing's not worth much. I mean, the other thing to keep in mind, I mean, since the beginning of the century, or even since 1971, the dollar has lost, 90+%. Since the beginning of the century, it's like 97%. And I think since 71, it's like low 90%. The dollar's lost a ton of value. And that trend is relentless, and it's just going to keep on going. So, I mean, we're all going to have houses that cost more. And I mean, this is why too, when we talk about Bitcoiners and say, well, it's going to be worth $1 million a coin. That's true. But the bad news about that is that, gasoline might also be $150 a gallon.
Yeah. So that's actually a fantastic point. That's exactly what I was thinking, is that if you inflate, if Bitcoin is that like fire alarm, right? It also raises the tide for everything else, right? Isn't it?
Right. No, that's right. Yeah, no, and by the way, you will have gotten ahead in Bitcoin terms. I mean, if you bought Bitcoin at 25,000 or 30,000, where it is today, roughly, it tears off to 500,000. You'll have done very well as an investor, but at 500,000, you might not like the price of gasoline down at the corner station. Gasoline might be much higher than you initially anticipated, right?
So it's about having the fastest horse, and thereby in this inflationary environment would be the soundest money. So it would be
That's exactly right. That's exactly right. I mean, Paul Tudor Jones said it. Bitcoin is the fastest horse in the monetary debasement race. Silver is right behind it. Gold's right behind that. And, they all represent a form of money that cannot be printed. But with the derivative risk in all three cases, it's pretty pronounced. It's already happened in gold. I mean, people say gold is, Bitcoiners say, well, gold's got all this monetary premium. It's going to lose its monetary premium. I say, bullshit. There's no monetary premium in gold. I mean, in general, in the world today, it costs about $1,300, $1,400 an ounce to mine an ounce of gold, plus all the capex and the time and everything else. And so what? It's selling for $1,900 an ounce. I mean, okay, that's a profit, but that's not like some enormous premium. Do you know what I mean? I mean, it's that's a profit spent on getting it out of the ground.
But you could also say the same thing about Bitcoin. You also need energy to mine Bitcoin.
Well, that's exactly right. Same story. That's exactly right.
Yeah.
So,
So now we're just, I guess, also going towards a roundup. But before that, I would like, and this question has been, I think, asked to you like many, many times. Obviously, now talking about just sound money, we have then gold, silver, Bitcoin, and then crypto, which is different than Bitcoin. There's Bitcoin, there's crypto. What is to you the on one side the similarities and the differences, and how do you think this can actually form a happy family, to say?
Well, first of all, I hate all crypto. I mean, to me, there's really only one cryptocurrency, and I even hate calling Bitcoin a cryptocurrency, but I guess it is technically. There really is. Bitcoin stands alone, and all the crypto, including Ethereum, I think it's all worthless. And my opinion on that is based on the fact that the monetary policies on everything except Bitcoin are set by people. And Bitcoin is set by the network and the vote of all the nodes and all the people using it. So it's distributed, and we know the monetary policy. Ethereum has changed its monetary policy 7 times. So throw out all crypto. It's bad. It's fraudulent, and it's really hurt Bitcoin. And what FTX did is sad in terms of the way it scared people away from the one thing that's an important monetary development. So I've always said that I view this as gold is analog sound money and Bitcoin is digital sound money. They're both sound money. The reason they're sound money is the stock to flow is very high. The flows are low against the stock, and in the case of gold, they're about the same right now. They add a little under 2% a year to the base amount that's out there. One thing that's actually beautiful about Bitcoin in favor of Bitcoin over gold is that Bitcoin can go to $2 million a coin. The supply is not going to change. Math is the math. It's just going to, if it's a commodity, which the SEC has said it is, it's the one commodity in the world where the price is not subject to, or the supply is not subject to higher prices. I can assure you that if gold goes to $10,000 an ounce, we're going to mine more gold. Now, it's going to take time because it takes 5 years, 10 years to get a gold mine going. And, we're not going to go from 2% of the world's supply or 2% growth in supply a year to 10 or 20, but we might go from 2% to 4% because at that kind of a price, marginal deposits will get mined. And so I think over time, Bitcoin will subsume gold. I think it will be higher priced than gold. The industrial uses of gold are quite minor. It's less than 10%. I mean, in my view, gold is sound money and it's jewelry. And it will trend toward its jewelry value as Bitcoin becomes a more accepted form of sound money, because it's just so much easier to store and move around and transact in. And it's not, to date anyway, it's not manipulated. And so, I think the price of Bitcoin in fiat terms will continue to go up forever. And then I think eventually we will live kind of on a Bitcoin standard. And, I think the price of Bitcoin in gold terms will go up forever as well. But, I like those two better than any other forms of money out there. I mean, silver fits in there too with gold. I kind of put them in the same bucket.
So long-term Bitcoin will win.
In my opinion. But
gold and silver,
long-term might be 10, 20, 30 years. I mean, long-term's not next week. It's going to take time, right?
Definitely. Yes, especially in macro finance, it's never like overnight.
Right. I mean, my generation, when I look at older guys who manage money and they want to inflation hedge sound money, and you know this too because you're in the business. I mean, they go to gold and they're scared of Bitcoin.
Yeah,
and
we have businesses calling in say we want to like have a wealth being like keep a wealth and not lose it, so they buy gold.
Right. Yeah, and then they buy gold, and totally understandable. And I mean, the other thing, of course, the other huge difference between the two is just the volatility. I mean, gold has very rarely had 20% drawdown years. As you know, Bitcoin has a tendency to, grow like bamboo, go up 4 or 5x, and then collapse down 70%. And that makes it unsuitable for some people. What I say is the way you deal with that is just you're waiting. I mean, you don't need to put all your money in Bitcoin and ride this enormous roller coaster. You dollar cost average and try and build a 5 or a 10% weighting in it, knowing that the upside optionality over a longer period of years is superior to gold. I mean, in 2020 and early 2021, Bitcoin went up 5x in under a year. I mean, gold has never done that. And the reason that's true, or the reason that happened, is that they're both enjoying one thing, which is to say they both benefit from monetary debasement. We know that the fiats are melting, so gold's going to go up and Bitcoin's going to go up, right? The difference is gold's Lindy effect of 5,000 years of gold history. Everybody in the world knows what it is. It's been around forever, and it takes a lot of money to move that price higher. Bitcoin is this new speed rocket that just came out 15 years ago now. And, it's only maybe at a 10% adoption rate in developed countries. And, that adoption rate is going to go to 90%. So you've got an adoption curve occurring as use cases grow, and that's going to make it go up much faster. And that's why it's going to outperform gold on a price basis. But the cost of that is the volatility, as we all know. And
the standard deviation difference is insane, right? It's like 20-fold or something between.
Oh yeah, it's nuts, and I get it, and that's why it's sad for people who kind of get all hyped up on it. They buy in at 68 and it goes down, and they think, oh, I made a mistake. They panic, they sell. I mean, people need to understand the nature of what it is and how to approach it. And I've always advocated for dollar cost averaging. And the other thing, I mean, I'm sure you've seen the Weimar chart that Murmacan put out. I mean, when you have these big monetary transitions, which we're going through, and kind of similar parallels with the Weimar Republic failure of that currency, you're going to get big swings in these prices. And
so volatility is a precursor. Volatility, you would say, is actually a precursor to such
absolutely,
kind of events?
Absolutely. To me, that tells me something's going on. Yeah, it tells me something's going on. And if these markets were dull, I wouldn't feel nearly as certain about what's going to happen. But the fact that they're extremely volatile is telling me that there's big change coming here. Really big change. 5 years, things are going to look a lot different than they do right now.
Yeah. And so politicians are nervous, government are nervous. Gold is God's money. Bitcoin is people's money, and CBDCs is
the government's money. CBDCs. Everyone gets so worked up about CBDCs and the threat. Nobody I know is going to accept a CBDC or be excited about a CBDC. I mean, CBDCs may come out, they may launch them. I wouldn't be surprised at all. And people may accept them insofar as, okay, we're going to give you universal basic income via CBDC. Oh, and by the way, we're going to watch how you spend it so that you can't buy cigarettes and alcohol. And, if your social score is bad, we're going to give you less or, whatever. I mean, it's a control mechanism, right? I mean, all of that may occur, but no rational person is going to say, oh, I'm going to dump my money into a CBDC as a means of savings. Because a CBDC, all it really is just digital fiat. We've kind of got that. I mean, there's lots of digital fiat. I mean, you use Venmo or PayPal or whatever, but the CBDC is it can be printed. There'll be no supply limit on issuance, right? I mean, the beautiful thing, the reason that Bitcoin has value, the reason that gold has value, is that the supply. I mean, it's as Jeff Booth says, when money is scarce, times are good. When money is easy and free, times are bad. And Bitcoin and gold represent scarce money, and scarce money is the way it should be, because then people think carefully about how to allocate the money to create the most productivity per unit, and that's really what it's all about. I mean, Keynesians want growth. It's not about growth. It's all about productivity. If we all want to live better, we need more productivity. The key is, how do you get more with less? It's not how do you run the top line up. It's not about growing. And that's the real error of Keynesianism that never gets pointed out, never gets discussed. It's just wrong. We don't give a shit about what the GDP is. I care about how well people are growing or how well productivity is growing. I mean, throughout the 1900s or 1800s, people's incomes didn't go up at all, but their lifestyles improved immeasurably because they could buy more with what they had. And the price of things were consistently falling during that time frame. I mean, deflation is actually a good thing. And of course, try and get a Keynesian to believe that. I mean, no Keynesian would ever say that, but it's true. So, right?
I love that last part. Yeah. Well, thanks a lot, Larry.
Okay.
You on a roll. I could actually keep let you talk. It's just about it's on your side.
Sorry. Yeah, I know I tend to blather on, but
no, but it's
a subject I know a lot about and I like, and I'm passionate about it because I really, I've spent my whole life in this area, and it's, I don't know. I mean, I guess everyone gets their 15 minutes, right, where kind of things line up, and I just feel strongly about this stuff, and I think that the knowledge I have of it is worth spreading, because if we can get that quorum to migrate into these sound money areas, we can get a groundswell that'll change the system, and then all our lives will be a lot better. I mean, things don't have to be as messed up as they are right now. I mean, even as bad as it was in the 70s with the Vietnam War, overall it was a better society in the 70s. It was a more civil society. We've in my opinion, the United States is not the country today. It's not the country I grew up in, and not for it's not for the better. It's for the worse. And so I think we need to kind of go back to first principles, which is, if we had sound money, that would be the most important first principle, in my opinion.
Yeah. So if I kind of like a thought that actually occurred to me, and this is a bit of a wild brain fart, I would call it, is the only way to actually sustain that kind of system is either come up with a global dictatorship that imposes the use of kind of money or anything that through coercion basically forces people to live in a certain way, or like China is a bit of an example of how it might look like. But in the end, people might then not accept that kind of rule. So in the end, all of those dystopian ideas that CBDCs might be, like the first door towards like this globally led, like some people go really wild with the World Economic Forum and all those kind of institutions that they think are controlling people all around the globe. You don't think that this is realistic because people will not accept that?
Yes, I think that's right. I mean, and I think, the dystopian would, get to sound money to do it from a dictatorship. I mean, I actually think, and this is kind of a religious belief, but it's actually there's kind of a God-given belief here that, Americans and people in the world in general ultimately always do the right thing after they're shown what the wrong thing is. And so my opinion is that what will happen because of the math is these currencies will collapse. And that will be pretty bad and kind of an unmitigated disaster in a lot of ways. It'll be a real fourth turning tragedy. I mean, it'll be written in history books for hundreds of years. And our grandkids will be thinking, how the fuck did these guys let these central banks set interest rates? I mean, what were they thinking? I mean, they must have known about the debt cycle and debt loops and And so, the currencies will collapse. Everyone will go, what happened? Well, we printed too much money. Money wasn't sound. And, sure enough, 5,000 years of recorded history shows that when you do that, currencies collapse, and they did. And so then they'll say, well, how do we solve it? Well, okay, let's go back to the past. I mean, take Weimar, take any place where currencies are collapsed. What do? You go to a sound currency. You don't create what just didn't work. You start over at first principles with a sound currency, whether it be gold or, whatever it might be. And so, and therefore, I think all people will come to that conclusion. They will be educated. They will see how and why it collapsed, and they will collectively come to the conclusion and demand that we have a sound currency, that we go back to sound money, or the countries that do it first will enjoy enormous benefits over the others, and then the others will follow.
Mm-hmm. But don't you think that the smart ones, they already know that? What you're just saying, like those people in those circles, the elite, I would say, they're not dumb, and they probably heard maybe some of your podcasts or someone else that's laid out.
Look, there are a lot of smart people who are buying gold. Yeah. And there are a lot of smart people who are buying Bitcoin.
But then,
Yeah, but not the people in the governments today. Not the. I mean,
No?
there are a lot of people, and no, I mean, they're buying it as a tail risk hedge. They're not. I don't think they think with the certainty that I believe that it's going to happen.
Mm-hmm. Or maybe governments already own Bitcoin, but we don't even know it. Or
well, that's possible.
That might be those kind of things. So that the ones, basically, my point is the ones who are already in power in this kind of system, they will look ahead or know preemptively as a security, just as an insurance, have either gold or some money in their balance.
If they're smart, they will. Some of them are incredibly arrogant. I mean, it's, you got to remember that when you get that rich off a system that's broken, it's Sinclair, right? It's hard for them to understand something that doesn't benefit them. Look, if they're smart, they'll pivot, get it, say, oh yeah, geez, we had a good run here. Time to go buy some of that shit. But you also see some very rich people, shitting all over this stuff. I mean, I can assure you that, Charlie Munger, not that it matters because he's old and he's going to pass, but I mean, I can assure you he doesn't have any Bitcoin. I doubt he has any gold. Do you know what I mean? And, he's a smart guy, right? So, it's, it'll be interesting to see. I mean, frankly, I hope they don't have very much of it because I want to see the people who have, I mean, I know universally the people who have sound money generally tend to be pretty moral, ethical, thoughtful people that, don't want to rule over others or take advantage of others. And so, I want to see those people have it, benefit, and get a word in how the new system gets structured versus the people who are running the broken system that, have benefited at all our expense.
Yeah.
So.
Okay, fair enough. Makes sense. We just reached 1 hour and 20 minutes.
Yeah, I gotta go because I know I am out of time now. So I really enjoyed talking to you, and I'm happy to do it anytime, within reason. So
sure. I'll definitely love to see you or hear you again. Also, if you come in Amsterdam, you'll be more than.
Yeah. Well, if you guys do another show, maybe I'll come this time. I couldn't come to the other one. I had a conflict, but if there's another Bitcoin show in Amsterdam, I'll try and make it. And I do know, I don't know if you're familiar with it. I did the one in Scotland last year, and that one is now moving. They're going to do it in London in October. So it's pretty close by. I mean, why don't you hop over to that and I'll meet you there? Yeah,
definitely. Let me know. Yeah. I'll be watching this and hope that I can make it then. But that's definitely something I can plan. Yeah. But to conclude it, thanks a lot, Larry.
Oh, thank you. Enjoyed it. Good questions.
Thank you. If people want to contact you, where can they reach out to you?
So I'm on Twitter, just at Lawrence Lepard. And then I have a website, EMA2, which is also on my Twitter thing. You can just see and click through. And I read a quarterly letter, which is free, which describes kind of the macro views that I hold. And I manage a fund. But it's for, wealthy individuals and institutions. The minimums are not trivial. So. But the best place is Twitter, and I try to respond to DMs as much as I can. And as you know, I do a lot of these podcasts too because I don't know. I view it as my mission to kind of spread the word on this stuff because I want to see that better world emerge. I want to see us get through this transition and return to sound money because I really do believe if we fix the money, we'll fix the world.
Mm-hmm. Well, there was some sound advice. Thanks a lot. This is
okay. Thanks, take care. See you.
Letter that you did print. Wish you a beautiful day, Larry, and hope to see you very soon.
Okay, likewise. Thank you so much. Take care.
Thank you.